Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody, and with me, as always, is the coffee connoisseur himself, Mr. Brian Alfaro. Good morning to you, bud. How are you?
Good morning, Cody. Nice to see you.
Always great to see you, bud. Always great to be here on the podcast talking to another great guest. Tell us who we're talking to today.
All right. Today we have the one and only Mr. Jeremy Roll joining the show. Super excited to speak to Jeremy. Jeremy started investing in real estate and businesses in 2002 and left the corporate world in 2007 to become a full-time passive cash flow investor. He is currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages a group of over 1,500 investors who seek passive cash flow investments in real estate and businesses. Jeremy is also the co-founder of For Investors by Investors, or FIBI, a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning amongst real estate investors in a strict no sales pitch environment. FIBI is now the largest group of public real estate investors meetings in California with over 30,000 members. Cody and I were actually just at one. Jeremy has an MBA from the Wharton School and is an advisor for Realty Mobile, the largest real estate crowdfunding website in the US. Jeremy also welcomes emails, which I'm sure we'll talk about here in a minute, and we'll provide his contact information. But Jeremy, welcome to the show.
Thanks for having me on, guys. I really appreciate it. I hope our episode is helpful for your listeners.
Hey, we appreciate you, Jeremy. And I tell you, we were talking a lot about this before the show, right? So Brian and I have had the fortunate pleasure of, following you for some time on other podcast shows, and really just gained a very respectful appreciation for your expertise and what you've done in your real estate portfolio. But we also had the opportunity to connect in California at the IIREC conference, which was awesome. So really appreciate you making time to be on the show today.
Absolutely. No, thanks for having me here. I'm looking forward to whatever you guys want to talk about.
Awesome. Well, for those of our listeners who don't know you, we're really excited to introduce you to our audience. But for those who do, I think will probably appreciate, again, your expertise. And that's something that we want to definitely have you highlight is, just your general outlook on the marketplace, what you've seen across the years of investing in your portfolio and kind of what you see for the future. But before we get into the kind of nitty gritty here, tell the audience a little bit more about you and your background.
Sure. Yeah. No, thanks again for having me on. So, I've been investing in managed opportunity syndication since 2002. Got out of the corporate world in 2007 thanks to the cash flow after I rotated out my money from stocks and bonds into more cash flow. And so I've been a passive investor for about 20 years, a full-time passive investor for about 15 years. And I invest across a lot of different asset classes, of course, including multifamily. It's for sure one of my top 4 favorites, and many other things, including real estate and non-real estate assets. I tend to be kind of like over-diversified or hyper-diversified or whatever you want to call it. I'm in a lot of things. And, when you do this for a long time, you just end up getting into a lot of different things over time. And I actually love the diversification concept, but just a lot to manage. It's an interesting time that we're recording this, though, because, it's now early 2022. There is now a war in Ukraine, unfortunately. There is a ton of inflation. There is the Fed possibly going to raise rates very soon. There is a lot going on. Stimulus just finished from last year. We're trying to get out of a pandemic. Good Lord. There are a lot of things going on.
There is. It is definitely an interesting time for sure. And this market cycle in general has been an interesting one to navigate, right? I mean, we were in a very bullish cycle pre-pandemic, now even more so post-pandemic. And I think a lot of people, ourselves included, have sat back and just really scratched their head wondering how in the world can this, tide continue to rise, so to speak. But yet it doesn't seem to be slowing down by any stretch of the means. And so, I want to highlight the fact that you are a full-time passive investor, right? I mean, you've done a variety of different investments across your portfolio, $1 billion worth of real estate and other assets, which is incredible. So, you're very dependent or very particular on the type of assets that you're investing in because, for you, you're very sensitive to a particular return metric, right? And I guess in this case is cash flow. Let's start off there and kind of talk about what is driving you as an investor to look across these different asset classes and why.
Yeah. So if you take the way step back to me and why I got into all this to begin with, I was working in the corporate world in 2001, and the dot-com crash happened, for those of you who actually remember that. And essentially, what the reason why that caused a challenge for me is because what it made me realize is that like the stock market wasn't necessarily a good fit for me, because I was watching my retirement account go up and down 30% in a year. And that's not because that kind of said to me, well, where's this going to be in 10, 20, 30 years with all this volatility? Where's my retirement account going to be? This doesn't seem like a good fit for me personally as a pretty low risk guy. I wanted more predictability. So I got into all of this and more the cash flow focus for more predictability. And so the reason why I continue that today is because I continue to really just want to look for predictability. And so I tend to favor cash flow, both because I live off the cash flow. So I've kind of been building this cash flow snowball for 20 years. And my goal is to never have to go back to the corporate world by continuing to build the snowball, right? But more importantly, I tend to invest in more stabilized stuff that may or may not have any value add upside. That's optional. And I have a perspective on, I tend to favor value add investments at a certain part of the cycle versus others, just for myself. But overall, I'm a pretty low risk person. So what I'm targeting matches what I invest in, but that predictability is really what I find most attractive about the types of investments I get into.
So in speaking to that predictability and, stabilized cash flow type of assets, more risk adverse assets right now, what are you seeing as far as opportunities across the different asset verticals that you're invested in?
Yeah. So you hinted at this a little earlier here that, we've had a record long growth cycle and, economic cycle. That was pre-pandemic, even record long. So we would have had a normal recession, then we still would have had a record long cycle. And that has made it very difficult for me to invest in the last few years, because asset prices got so high that I pretty much went into like a mentality of on the sidelines as of the end of 2016 because of high asset prices and low cap rates. And so since then, I've had to kind of either pivot and look at different things I wouldn't normally look at, or look at only unique opportunities where there was enough of a padding or kind of a price difference in market rate versus the purchase price that I felt really comfortable getting into something. That has actually become even more poignant to me since the pandemic started, and there was a lot less predictability in the economy since then, right? And so I've done very similar things for the last 2 years. And I would say, but since 2017, more of a mentality that I'm on the sidelines for regular market rate deals. Now, I don't want anyone to get confused. I still invest a ton. I can go over a long list of stuff I've invested in just this year, but so far, it's all going to be, I've kind of created a situation now where I'm targeting 3 buckets or 3 verticals of what I'm trying to invest in response to the current environment. And I'm very much looking forward to the time where we have a full cycle reset, which hasn't happened yet, and then once that happens, end of cycle, beginning of cycle, then I'm much more in the clear to do the stuff that I really love, which is the cookie cutter, more predictable multifamily and other stuff that I really am, fits me very well. Mm-hmm. So we can get into more detail if you want about the buckets I'm targeting, but I did that in response to the pandemic and uncertainty while I'm waiting for stuff to really normalize.
Yeah, I definitely would like to dive in there, Jeremy, and get a better understanding of those particular buckets. Again, Brian and I, when we saw you in California, we heard you on stage. I think having followed you for some time, we actually thought the same thing, that you had took kind of a hiatus since about 2017. It was, and then much to our surprise, you mentioned no, you're still investing. You've kind of strategically made some pivots where necessary to kind of, like you said, find those investment verticals that really fit your particular thesis. And so, was really excited to hear that, because it just, I think for those who may have taken that big extended pause and maybe sat on the sideline, really have missed a lot of opportunity. But like you said, it's just really finding those risk adverse opportunities that really fit your thesis has been the key. So, and
yeah,
speaking of,
go ahead.
You
and say something. For a full-time passive cash flow investor like me, if I stop investing for multiple years, I have a huge problem, because I have to redeploy the capital to keep the cash flow going, right? And now with inflation that we're dealing with, if I stop investing, it's even a bigger problem, because not only am I not redeploying the cash flow and having the usual cash flow problem where it's coming down, now I've got inflation eating away at a huge rate. And so it just practically like deadly for me to stop investing, right? And so, I mean, unless I start switching into like just more stocks and just, ETFs and make it very simple or whatever, like dividend ETFs. But the point is that I cannot stop in that eventually I'll have all these capital returns without any cash flow. right?
Mhm.
And I enjoy what I do, so it's not a problem for me. But yeah, I'm never ever on the side. It's very important for the audience to know that even in the worst of times, there's always unique opportunities that make sense. And in the best of times, there's unique opportunities. There's always unique opportunities. So it's just a question that they're harder to find right now, but I think that they're more imperative to find right now for someone like me. So sorry to interrupt.
No, I'm glad you did, because it's a really good point, Brian. And I know that we talk about this all the time, right? Where there's a very specific and strategic strategy that you need to be aware of when you go to be dependent full time on your investment cash flow, right? And if you're not strategic about that, and you're not well positioned to tolerate or handle certain downturns or certain cycles, you could be in a very vicarious position where you're starting to make bad decisions based on that dependency of the cash flow or income that you need from those investments. So I'm really glad you brought that up, because it's really important to highlight. Brian, any thoughts there?
Yeah, I love what Jeremy's doing, because we preach this all the time. He knows who he is as an investor, and nothing's going to rock the boat. He's looking for particular opportunities that are producing cash flow, because that's what his investing thesis is based off of, right? So I think a good message and nugget that I'm definitely taking away is, know who what you're investing in, as far as, are you investing for cash flow, or are you investing for equity, tax benefits, or what are you looking for in particular, and stick to that no matter what. So if you're investing a lot in short-term rentals, and they're doing great, but then they start not doing so great, you need to pivot and look for that cash flow, because your investing thesis is cash flow. So I think that's a great message to send to our investors. And Jeremy is a living example of somebody who has an investing thesis, and no matter what, no matter market cycle we're in, he's going to stay focused on that thesis and not pivot no matter what.
Yeah, and I just want to add to that, Brian, that I do focus on the underlying core foundation of cash flow and everything I invest in. Now, look, I'm going to be honest. I have 1% of high risk stuff, and I have a little bit of medium risk stuff, right? But my core foundation, and the vast majority of it, is what really fits me really well. The other stuff's more opportunistic in odd situations. But what I was going to say is that I take that core foundation of cash flow, and I can layer on value add on top of it, for example, not in lieu of it, at certain parts of the cycle, which is important, because I do think that it makes more sense to take more risk at certain parts of the cycle. But you can get blended risk. You can get cash flow plus some value add upside, right? Where you're actually cash flowing from day one, where you're cash flowing to your minimum criteria from day one, but also potentially getting the value add upside sometimes. So there are times where I don't just do 100% pure cash flow, like in terms of typical deal, but it's always going to be the underlying core foundation, with the exception of odd, unique. I'm in 10 startups, for example, and we can talk about those too. Some of them have done very well, some of them you may know even, but my core foundation is exactly what you're talking about. That doesn't change.
Yeah. And it seems so rudimentary, right? We talk about understanding economic market cycles and things like that. But I think I would argue that most passive investors, or many passive investors rather, probably don't have a good fundamental understanding of those particular economic market cycles that really impact us as, commercial real estate investors. And so I think it goes without saying, it's really important that you get very educated and understand those cycles, so that way you can make smarter, sounder investment decisions. Because as you mentioned, you can find opportunity in any cycle. It's just a matter of, is it a sound investment vertical? Do you have the fundamentals backing that decision? And, is it a fit for you as an investor? So it's really important to identify that. So I like that.
Yeah, Cody, let me just add something that's really important with that too. I talk to a lot of new investors all the time. Happy to speak to new investors if I can be helpful. And sometimes I'll hear the following, which I like to hear in general, which is, okay, I'm in the corporate world to have a W-2 job, but I want to get out in 5 years, 10 years, 7 years, whatever the plan is. They have a plan, which is fantastic. They say, look, I got to deploy X amount of capital every year for the next 7 years, assuming this cash flow amount, so I can get out, right? And the first thing I say to them is, well, look, it's fantastic you have a plan. Obviously, I love seeing people get out of the corporate world. It's completely changed my life for the better, as far as my experience. But just because you now are in a position where you have capital to invest, does that mean the timing is right from a market perspective, right? And I do find a lot of people don't take the high level step back, determine where we are in the cycle, determine if it so let me give a really easy example. If you just happen to have cash to start in 2006 or 7, right? Does that mean that's actually the right time to start? Maybe, but depending on what you're doing, maybe not, right? But a lot of people don't take that into account, because they're not taking time to really get an opinion of where we are in the cycle, I think, and then decide if they should start this year, or maybe they'll delay a year or two, right? Because if you start in 2006 or 7, even though you have this great plan to go out 7 years, that could get completely changed or derailed if you start and do it, at the wrong timing potentially, right? Depending on what you're investing in. So I want to point that out too, because I think that's a very important piece of the puzzle for someone to consider if they're just starting out, for sure.
Yeah, we appreciate that, Jeremy. Thank you for highlighting that. And so I want to get to the conversation about your economic outlook and how that is driving your investment decisions today. But before we do, I want to go ahead and get to those 3 buckets if you can. Talk to us a little bit more about those 3 buckets that you're investing in now, and really why.
Sure. So this is in response to me pivoting, right? So especially when the pandemic started, what do I look for? And especially amongst so much lack of predictability and uncertainty. So I'm looking at the moment at 3 different buckets. The first bucket is unique opportunities, like we talked about, that have unique pricing or some unique aspect that creates padding for someone like me, because my number one concern right now is I am very concerned that interest rates may continue to go up. We may have an adjustment in asset prices, and I don't want to get into an opportunity at the wrong timing for asset prices, because my investment thesis is cash flow, not value add for the most part. And I don't go into a deal with a lot of padding, so we have to buy it right, in order to cash flow on it for a lot of years and be in a good position. So I can give you some examples, but that's certainly one bucket where sometimes they're just unique, compelling opportunities that add a lot of padding in some way with pretty low risk as far as the likelihood, the high probability of the padding existing, that get me over the hump. And just very quickly, like I'm actually investing in a multifamily deal, believe it or not, next week that I'm looking at right now, that is just, it involves tax abatement or tax abated opportunity. It's a very unique situation. It's going under contract as a regular market rate deal. By the time it actually is closed, it actually turns into income restricted for half the building of the units, with literally 85% of the taxes are removed. And this is in Texas, where taxes are very high. So, I mean, just to give you an idea with some numbers, they're literally eliminating 41% of the expenses without any hit to the revenues. Okay, so if you actually, if you can imagine what that appraises for by the bank who's providing the loan in the new structure versus the old structure, for those of you who are very experienced, you'll understand if you remove 41% of the expenses but don't produce any revenues, and you're buying a Class A apartment building at a 3 or 3.5 cap, and you're multiplying that savings by 33, you have a tremendous amount of built-in equity at closing. And essentially this building, it's a Class A property. It's being purchased at it's actually 2 property portfolio, but it's being purchased at a 5.59 cap, true Class A 2013 and 15 construction, 96% blended occupancy. You cannot find that anywhere right now. And it's only done because of the fact that it's the structure is being changed before closing, and they won't close. There's a contingency, they won't close unless the housing authority signs the agreement for the new structure. So that to me is just a ton of padding, and I get the bonus of much more cash flow than normal from a Class A property from the start, all the padding, and the way it's structured has actually got more depreciation upfront in year 1 than a normal deal. So there's a lot going on there. I know we can unpack a lot for that, but the point is that it's just one good example. Like that's going to put me over the finish line versus a regular market rate deal right now, given that there's padding in case there's a price adjustment in the market, right? So sorry, I know it's a little complicated, but it's a real deal right now. So.
No, that is incredible. And that's very unique, because you don't hear that playing out too often. And I tell you, being here in Houston, being here in Texas, taxes are a significant expense. And so, like you said, reducing that by 40% off of your NOI already without having to do any execution is absolutely incredible. So you talk about layering in that less execution risk. I mean, you've almost eliminated. Can't guarantee it completely, but you've almost eliminated all the execution risk that comes along with implementing, revenue increases, other things like that. And so really then it just becomes a pure management play, I'd imagine, right?
Right. Well, look, like every other property right now, the new lease turns are actually achieving a 20% increase in rents without any rehab. They're going to rehab the units anyway, but so there's also that value add piece. But that to me is, I didn't even mention it because that's not what I care about, right? I care about the padding. By the way, those 2 properties happen to be in Katy, just so you know.
Ah, Brian, there you go.
For me.
That's in Houston, just so everybody knows. Yeah.
Awesome. Well, before we continue to unpack that, so you got the unique opportunities with padding. What's the second bucket?
Second bucket is short-term opportunities. And the reason why is because if I'm concerned that asset prices could potentially adjust in the next 6 to 18 months, call it, then if I can get my money working to kind of try to keep up with inflation as much as possible, but then get the capital back relatively quickly, and then redeploy it into potentially better pricing, right? So having it work, but then having access to it is really good for someone like me instead of having it sit like we talked about, which could be really deadly from an inflation perspective. So, I mean, really easy example, I have a few examples, but one really easy one is just hard money lending. I do this every year normally anyway, depending on market conditions. Been doing it since probably 2007 or 8. And I did a record amount of it last year because, you know, for those of you who are not familiar, hard money lending is providing a first position loan to someone who's flipping a home. And if you're doing it at the right loan to value, there's a cushion and it's pretty safe, right? Depending on who's executing, et cetera. And last year, supply and demand imbalance was very much in favor of someone who's flipping a home, right? Because there was very low supply, a lot of demand. And so that reduced the risk if you're lending on that property to have it flip, right? Because the prices are going up as it's being worked on. So I think market conditions are still pretty favorable from a supply demand perspective, probably not as much as last year for a lot of reasons, but still probably okay. So I'm doing quite a lot of that right now, just having my money work this year while I'm waiting to see what happens by the end of the year as to whether I should redeploy it into that next year or redeploy it into apartments or whatnot, maybe if the pricing is adjusted. So that's just another example, short-term stuff.
Now, when you look at short terms too, are there any other strategies other than like hard money lending, for example, that are available?
Yeah, well, so another kind of subsection of this is something that if you can get a return to capital pretty quickly, it's somewhat equivalent, right? Because if you can take all the risk off the table, get your money back and redeploy it, it's the same thing. So I'm just going to is it okay if I give a non-real estate example?
Yeah, please do.
Okay, so there's two of them I could think of, but let me just go with the one that a lot of people might be familiar with. So I don't invest in Bitcoin. It's definitely the wrong thing for me because it doesn't provide cash flow. There's no predictability. Every day it's extremely volatile. It's almost like opposite of checking my boxes, right? But I want to get exposure for diversification to the asset class because I don't know where it's going to go. It could go up, could go down. Just could be good diversification. So the way I managed to do that was I invested in a Bitcoin mining fund. And through someone I've known for a long time, and he has a very big scale. He's probably going to raise over $100 million this year alone. He's got a few other funds in the past. And so what people don't understand with Bitcoin mining, like he has a $10,000 cost to mine a Bitcoin. Bitcoin is currently at 40,000. So, you know, for someone like me who doesn't want to lose money, right? That's the worst case scenario if possible. You know, if I invest in a Bitcoin today at 40 grand, it goes to 20 grand, I've lost money, half my money. If I invest in the Bitcoin mining fund and it goes from 40 grand to 20 grand, I've actually made money. So now the trade-off for someone like me is that I'm giving up some of the upside because there is a split of the profits once you have a return to capital. So the way it's structured is that there's no fees or anything. You just have 100% return to capital through cash flow, monthly cash flow payments as they're mining the Bitcoin until payback to investors. And then there's a 50-50 split. So they're taking a lot of the profit beyond investors getting paid back, but they're taking the risk off the table as quickly as possible for investors with no fees. And so if you're really bullish Bitcoin and you think it's going to go to 500,000, you do not want to do this because you're going to lose a lot of the upside. But if you're like me and you want monthly cash flow and you want to be able to reduce some of the risk of being in Bitcoin and still somehow benefit from it and get diversification from it, it's a really good fit. Furthermore, by the way, we get 80 to 90% bonus depreciation in year one. And so the payback period, so now that I've said all this, the payback period for something like this is projected to be about a year with the depreciation if you can use those benefits, right? So I get to take my money off the table projected at these levels in about a year, and then it's going to keep going for several more years, but now I got that money back to redeploy it. So that's a subsection of the short term, because if I get all my money off the table in a year or very short, or relatively short term, that checks that box as well. So I hope that wasn't too complicated. Sorry.
No, that's interesting. We'll have to get you connected with our partner, John. He's a crypto quote unquote genius, as we like to call him, but he's big into that. But I didn't realize I'm like you, Jeremy. I don't know very much about crypto at all, or at least I don't participate in much at all. But I didn't realize you could take depreciation on Bitcoin mining. That's Brian, were you aware of that?
I believe it's on the equipment code. Correct me if I'm wrong, Jeremy. It's these, they set these warehouses and they buy all this equipment that can be depreciated.
Yes, exactly. So the 80 to 90% is because the vast majority of the money is being allocated towards buying the miners, the actual computer equipment. And it's all hardware. And we're 2022. This is the last year of 100% bonus depreciation on equipment. It's supposed to sunset out 80% next year, all the way down to zero in a few years. So it's 80 to 90% bonus depreciation, because not 100% of the proceeds are going towards the equipment, but specifically there's rent and everything else, but it's a very high percentage.
That's interesting. See, learn something new every day. That's awesome. Well, what's your third bucket, Jeremy?
Third bucket is, I'm worried about asset prices again, and we've talked about that. So how do I avoid that? Well, what if I invest in something that is already going to depreciate, and I expect it to go to close to zero. So I don't care if it depreciates more quickly because there might be a recession. I care about the predictability of the cash flow it generates, right? So a really good example, I've been investing in ATM machines since 2008. It's been a long time, very successfully, thankfully. And I just deployed some more capital into an ATM fund just 2 weeks ago that, it's actually a similar profile. Not only do I already know that the equipment's almost going to zero, right? So the projected residual value of the ATMs in 7 years is 5%. You have like a computer, a keypad, a bill feeder, a screen, that's all going to zero. We know that already, right? But I've been through a recession back in 2008 with ATMs. I've seen ATMs go through the cycle, and I'm pretty confident in the predictability of the cash flow, just in my own opinion. And so even though I think a recession may be coming up, I'm not concerned about the viability of that and the profit margin and everything to do with that. And so another thing that ties into, though, is that you get 100% bonus depreciation in year one. And so between the projected returns and the bonus depreciation, you're projected to get 60% of your capital back in year one, 85% within 2 years. So again, I get the vast majority of my money back, not only taking the risk off the table, but more importantly, being able to potentially redeploy it and compound it into potentially lower asset prices on stuff like apartments, maybe. We'll see. So that kind of checks two boxes of, okay, I'm investing in something that's going to depreciate anyway. I don't care about whether it goes to zero, right? Where I'm concerned about most asset prices changing and going down because I'm not reliant on that. But it also gets me a relatively quick payback period. So it falls in both buckets, but it's a good example of something that's depreciating to zero, and I don't have to worry about the asset value.
The first time I ever heard of investing in ATM funds was actually you on a podcast. And this was, I don't know, probably a couple of years ago now. And I really thought it was so compelling and very interesting. And having talked to a couple of people like yourself who've actually invested in similar funds, probably one of the highest yielding investment verticals that at least I've seen over the past several years. I don't know.
But it's deceiving though, because so just an example, the fund I invested in is projected to yield about 25% cash flow returns paid monthly each year, right? And that sounds very high, but the problem is that you have a 5% residual at the end. So it's very different than real estate because you're getting a tiny payment at the end, and the cash flow is giving you what I'm going to call kind of a return of principal and interest together. It's not really that, but just if you think of that visually. And so the return, the cash flow has to be higher to make sense of the total return because there's very little payment at the end. There isn't this big payment like an apart building where you get your money back and some profit potentially, right? So it's a little tricky in that the cash flow is deceiving, but the IRR is pretty high. The IRR is in the 18s or 19s, if I recall correctly, projected return. So, and that's because the cash flow is coming back pretty quickly. So I just want to point out, even though the cash flow sounds high, it's because you're getting kind of principal and interest back together.
Yeah, that makes sense. So Jeremy, I'm really impressed with these three buckets you have, this portfolio, this diversification of both risk and return yield, I guess, so to speak, that you have here. You're positioning yourself to what you would describe as hedging against whatever future downturn we're about to come across, in your opinion. Let's talk a little bit more about that. Let's talk about kind of your economic outlook and why do you feel there may be a looming downturn coming?
Yeah, well, so look, I would say that 2021 we had a lot of tailwinds. We had a ton of stimulus being put in people's pockets. We had asset prices going up, and we just had a huge party of people being able to spend a lot of money that the government gave them because there was $4.5 trillion of stimulus money printed and $9 trillion of assets purchased by the Fed, which is insane, right? And just insane in terms of the amount. Now in 2022, we have headwinds where we have no more stimulus, no more emergency pandemic unemployment programs, eviction moratoriums are lifted, all these other things, and it's kind of working against you. But now we have, equally as importantly, we have very big inflation, which a lot of people, I think, confuse into the supply chain, when in fact, the inflation only happened and messed up the supply chain because so much money was given to people, it caused an unbelievable amount of demand that wasn't normal, right? And then the supply chain couldn't keep up. That was made worse by the fact that people were home, weren't producing things, and they couldn't produce those goods that they were trying to buy or other people were trying to buy. So, but the bottom line is that now we have inflation as a result, and people are starting to fall behind from that. A lot of people don't realize the last 11 months, real wages, which is inflation adjusted wages, are down in the US, right? And now people don't have that pandemic stimulus anymore. So we're facing a lot of headwinds, and we also have oil prices now at sky high rates. And I hate to point out, but unfortunately, literally in the past half a century, every time oil has gone more than 50% above its median kind of trend line, or long-term trend line, not median price, we end up with a recession. If you look at the chart, it's every single time. And that's because oil is involved in literally almost everything. And I don't just mean that, like, I'm looking at my computer, there was oil needed to produce the plastic here, right? But then also, if you buy something, it's got to go on a boat to get to you, or on a train, or on a plane, or on a truck, or all of them, right? Almost. And that's going to increase the cost of you getting it. And then what's exacerbating inflation on top of the oil prices is that almost 10 million new businesses were formed in 2020 and 21, and people got all this money, which is and those are record numbers, by the way, brand new business formations. Those people are not trying to find jobs, which is causing a job shortage, right? Which is actually meaning that employers are going to have to pay more money if they actually want to either get something from another source or hire somebody. And it's an inflationary spiral, because you got to pay someone more, you have to charge more, and then that person needs to get a higher wage to be able to survive, right, and buy things. So we're in a very, very challenging time right now. And between the oil being very high, and probably the most important indicator that I tend to watch, which is the yield curve, we're almost at an inverted yield curve, which in the past century has correctly predicted a recession almost every time, with the exception of World War I, World War II, and the Great Depression. So it's a very, very solid indicator of a likely recession within 6 to 18 months. We're like in the 2 to 10 year yield spread, we're only about 25 basis points from inverting. It's really just crashed. And that's because the market is seeing the fact that the economy is just having all these headwinds together, and is realizing that there's no way that it's going to be able to avoid a recession, most likely. So, if we see the yield curve invert, then the countdown is on as far as I'm concerned. I want to point out to the listeners too, that we actually had an inverted yield curve in 2018, in the second half of the year, that was projecting a recession midpoint actually in March of 2020, just before the pandemic struck. We were already about to go in one anyway. So we already hit the end of the cycle then, but then it was prolonged by all this money printing. So anyway, those are some of the things I'm looking at, some of the things I'm concerned about. But to me, these are like very high probability indicators that we have a very, very high probability of a recession within the next 6 to 18 months, call it.
Yeah, I think you bring up a lot of great counter arguments to a lot of the common narrative that we're seeing out in the marketplace right now, right? You have the counter argument that there's a lot of liquidity in the marketplace. I mean, you mentioned that, right? You had all this money printing and whatnot that really went into the hands of not only, residents and things like that, or business owners through PPP programs, but you had a lot of capital that was made available to banking institutions, which are lending out to, big operations, right? Your Blackstones, your right, major institutional buyers that were looking for more of those recession resistant asset classes. You're looking for more protection against some of the other exposed verticals that they were, retail, office, things like that. And so you saw this massive shift and injection of liquidity into multifamily. We'll shift into talk about multifamily. So you have that. You have historical data that would argue that during inflationary periods, in general, multifamily investors, operators typically tend to do very well through inflationary periods, because that typically equates with rent increases, overall NOI increase, blah, 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 asset value inflation you mentioned. And then you have, because of that demand, you now have this extreme cap rate compression that we've kind of alluded to already, right? We've just seen this massive compression of cap rates. And I think I've heard you in a debate talk about, can cap rates continue to compress versus contract with the volatility in the interest rate market? So, that's some of the counter arguments you would hear, to that. What are your thoughts on some of those arguments?
Yeah. So the first thing I'll say is that there is always the most liquidity at the end of a cycle. That's the way a cycle works, right? So there was a ton of liquidity going towards startups before the dot-com crash. There was a ton of liquidity going towards houses and other things in real estate before the Great Depression in 2008. And there's a ton of liquidity today, which is exactly what you'd expect at the end of a cycle, right? And so, I think that interest rates going up are kind of one of the most obvious indicators, because one thing you talk about cap rates continuing to compress. Well, there's a point at which a real estate investor doesn't buy something with leverage, because leverage is actually negative, meaning that you actually have the cost of capital being higher than the actual multiple you have to pay for it. And then investors will stop. Right? They won't be able to use, it'll be negative leverage, and they won't be able to use the leverage. It's actually going to hurt them for taking that loan. And as interest rates start to go up, you start to creep up to that break-even point. So the cap rates are facing headwinds as opposed to tailwinds as far as where they're going, just because of interest rates, if nothing else, right? And then we have all these other factors we're talking about. So I don't know. To me, because I read a ton of news every day, it's crystal clear. Like, I'm a very quantitative person, and I try to keep objective because I'm just trying to figure out what to do as an investor, right? I don't really care if it has to be X, Y, or Z, but I got to know where I am in the cycle. And looking at oil prices and yield curve with no other discussion whatsoever tells me almost everything I need to know, just in terms of the probability of a recession, you know?
Yeah, again, very, very good points there. And you're right. I mean, historical data would definitely support that thesis and those arguments as well. Brian, you look like you have some thoughts there.
I just love how connected Jeremy is to what's going on in the economy. I think that's a really important lesson for our listeners to know, is if you shouldn't be blindly investing without knowing. If Jeremy said something that you didn't understand, you need to go back, record, write down what he said, and then go do some homework, because these are all very important things that, regardless of whether you agree with Jeremy or not, you need to be well informed and understand where you're at in the market cycle, what these terms mean, and how they can impact your investing strategy and your long-term investments that you're making. So this is an awesome conversation.
Yeah, I just want to add to that I think it's really important to understand that when I make an investment decision, I'm trying to think 10 years out for most of my investments. Now, not some of the stuff we talked about before in these unusual buckets for me, like the 1-year stuff, but in my typical stuff, I'm looking for a 10-year, fixed rate loan for more predictability, right? And that's why it's so imperative, even if you're investing in a 5-year deal, which may be more common these days, you need to think years out, not months out, not what looks okay today. And so in order to do that, you've got to do a lot of research and formulate your own opinion about where we are in the economic cycle and what's coming up. That's why it's so important, because you are going into more of an illiquid type of investment that's very hard to sell out of. And so you have to consider yourself locked in for the timeline, and therefore you've got to research the timeline to understand what you're getting involved in if you think it actually makes sense. So I am concerned a lot of investors don't think far enough out,
Yeah, I would probably agree with that, right? I think you have a lot of people that are seeing the impact of having investments in real assets and the wealth that's being created, and people want to get in because they want to have a piece of that pie, but not understanding that, like somebody like yourself, like you said, you've been investing for many, many years. You're very data driven. You have to stay in tune with the market. Like, you didn't just learn all of these points and principles overnight. I mean, it took you time and probably had a couple of bad experiences along the way, I'd imagine, to really learn that. So I think it's important for people to remember that, getting into these type of investment offerings, all of them have some degree of risk, but your education and your patience really play in your favor when it comes to making these investment decisions. I'm sure you would agree.
Yeah, and I will say that, look, I've lost out on a lot of stuff in the last few years because of all the craziness that's happened and all the money that's been printed and everything. But, I've sold, well, I've been in some sales in the last few years that I think in retrospect will look like they were very well timed, right? But it's always hard to know at the time. But I will say that for someone like me who is more conservative, sits on the sidelines, I think that someone who's more aggressive will probably do better in the long term. Right. I just happen to sleep well in my approach for myself, and it's the right fit for me, but I'm not at maximizing everything. It's more just like blending what I'm looking for in my personality with what I think makes sense, and just trying to get some type of balance. But I do think some people who are constantly deploying and being more aggressive will definitely have a better total net worth, for example, in 20, 30 years, whatever it is. So there's 1,000 ways to invest, and I say none of them are wrong. It's whatever is the best fit for somebody.
Let me ask you this, Jeremy. Looking back over the years of experience that you have, and the different verticals that you've been in, do you feel like your expectations have changed along your journey, or do you feel like your principles now still stand true to where you were, say, 10 years ago?
Yeah, great question. So, the one big thing that's happened that I've seen is obviously cap rates have come down a lot, right? Even in multifamily, all the asset classes. And that's made cash flow much more challenging to find at levels that I have been accustomed to in the past, and I like to personally be able to deploy into. And so one adjustment I've had to make is just understanding that as cap rates come down, cash flow comes down, I'm going to have to adjust, and I'm just going to have to be okay with it as a cash flow investor. And so one thing I'm very concerned about, which is kind of complicated discussion for now, but I think that the next cycle, once that starts, will probably be somewhat predictable in that we'll probably have growth every year like a regular economic cycle like we've seen for decades. But I think it's going to be very low because of all the money printing and the continued debt we've taken on, which started probably in the 2000s. So in the 2000 decade, we had potential GDP growth in the US of probably about 4% a year with the debt overhang we already had, because we already had some debt. In 2010 era, we had about 3% GDP growth potential. And that's why, like with President Trump, no matter how hard he tried and how much he said, couldn't get it to 4% because we had too much debt overhang that was impacting the ability for the economy to grow as far as the debt service for the government and stuff. Now, I think after this recession, whenever it comes, I think we're going to have between 0.5 and 2% GDP growth per year. And what that tells me is that the next recession after, when they do print more money to get out of that, if they do, assuming they do, then we're going to be in a Japanese positioning, which I'm very concerned about, which means that in a given year, you can have between -1 and +1 GDP because you have so much debt. And as an investor, one thing I do rely on for predictability is that the economy is going to grow every year, right? So that means that rents can grow and they can grow with expenses, et cetera. Once that is out the door, and I don't know if in 2 years we're going to have 1 negative GDP quarter, 3 negative GDP quarter, it's completely less predictable, right? I cannot count on the economy growing. That's my major concern coming up, to be honest, is I think this will be my last normal cycle. The next one where I can count on that predictability, and then I need to shift my focus completely. I don't know yet, but that's going to be very tough for a cash flow investor after that point. I'm even talking about regardless of what cap rates are. So,
yeah, another great interesting point there, Jeremy. And there's a lot of dynamics to unpack there, especially from a macroeconomic standpoint, global economic standpoint. And you're right; it's probably unfortunately another discussion for another day, just because you could have much more debate over that. But I want to get your opinion too. Like when you talk about buying real assets with debt and you look at the quote unquote devaluing of the dollar now with all the money printing, many would agree that buying assets now with leveraged debt in place now is really where wealth's going to be created, because obviously years from now, it's going to take so many more dollars to buy that same asset. So what do you say to the position of, people much like Brian and I, where we're like, hey, now's still time to buy as many real assets as we can. And like you say, be in a position to hold those assets for longer term. What would you say to that?
I think that makes a ton of sense into the long term. I think that, I'll give you an example. I'm actually going to be investing in the next couple of months in a buy and hold single family fund, right? Of 30-year fixed rate loans for the exact reason. We're locking in these rates right now, wherever they're going to go to. But the unique thing about that is that the average cap rate is going to be about 8% pre-leverage. And then you got a ton of you're into the double digits year one in cash flow. You're going to lock that in for 30 years. That's a great thesis. And you're in a hard asset that's probably going to, increase in value over time because of inflation, right? So I think that it makes a ton of sense. And that's actually why that I'm actually comfortable going into these deals with padding, even on a 10-year basis, forget a 30-year basis, because I do believe that longer term, once we get through this next downturn and everything, that unfortunately interest rates are going to have to head lower because of the debt overhang. And so I think that we're going to end up with lower cap rates in the next 5-10 years, which means that asset prices are going to go up, right? So there's two different ways you can play it then. One is you could say, look, invest in the asset today. I don't care what the price is. If the cash flow is good enough and you think there's a lot of predictability of demand in that asset, be it a multifamily asset, then we'll just get through the recession. Maybe there'll be a little bit less cash flow, but in 10 years from now, we're going to be in a very good position, right? And I think that investor is going to do better than me because I tend to sit on the sidelines instead and wait for the right pricing, right? And then I might get more cash flow, but I've also lost out a little bit. It's a comfort level thing. So I do think in the next 5-10 plus years, I think hard assets are going to be a great place to be. I'm just thinking that I should wait another 6 to 18 months to get a bit of a better pricing on it for myself today. Doesn't mean it's the right move for anybody else listening to this.
Yeah. So just in case anybody missed it, speaking to this potential economic downturn or cycle that could be coming, what is your projected timeline on when you think we'll start seeing that impact?
So all you have to do is watch the yield curve, and once the yield curve goes negative and the spread between the 2 and the 10-year treasury, then historically the majority of the time you have a recession within 6 to 18 months. Maximum is typically 24 months. So you can kind of say probability wise you're in a 6 to 18 month window, but it's important to understand that that doesn't mean that the stock market's going to go down in 6 to 18 months. And it doesn't mean that asset prices will go down potentially. I'm talking about apartments, say, in 6 to 18 months if they correct, or cap rates will change, because the stock market tends to be forward thinking. So that's why the NASDAQ's already down 20%. It's already taking some of this into account, but not quite all of it yet, in my opinion, right? And so the stock market may be much lower before this recession officially starts. But once the yield curve goes negative, all these traders are going to know that's the case, right? And they're going to start reacting to it even more. With asset prices, as we all know, real estate tends to adjust quite slowly. And what could accelerate that, though, this time is interest rates going up and affecting things more quickly, combined with a recession where you have, maybe less demand for at certain rent levels or whatever it is. So we have an impact on both sides here, but you have to assume that real estate adjusts slowly. So you have to assume that's going to take 1 to 3 years essentially to fully adjust. But I always say, like, you don't need to wait 3 years until it's fully adjusted, right? When you were investing in 2009, you didn't have to wait till 2012 until we hit the bottom. You could get into a deal that maybe was just really well priced in 2009 or 10 to add some more padding, knowing you weren't necessarily getting in right at the bottom, but you were getting in at a good enough level that it would make sense for a long-term hold. So those are my perspectives. But if you'd have to look at one thing, just look at the yield curve on the 2 to 10 year, and then expect a recession with the 6 to 18 months after it goes negative, which could happen anytime now.
Yeah. Well, and Brian, I know you and I talk about this all the time, right? The Fed is in a very vicarious position. There's multiple variables that play into the 10-year Treasury, right, and what impacts the yield curve. But looking at interest rates, particularly right now, which is it's top of mind for everybody, is the Fed has a very vicarious position where they're trying to control inflation with rate hikes, but then at the same time, if they get too aggressive, could easily put us back into a stalled or stagnant period where those rate hikes could eventually put us back into a recession type environment. So it's a very interesting dynamic. I definitely wouldn't want to be in Jay Powell's seat right now making those decisions. But
no.
Yeah, it's a lose-lose proposition. And that's the reality. A soft landing that everyone talks about is almost a fairy tale as far as probability-wise. It's a very low probability we're going to have a soft landing, very high probability that the Fed almost always puts us into recession as they're raising rates, right? That's kind of an end-of-cycle phenomenon. And what I would say is that, in my opinion, so the inflation data came out for the past month, actually today, and it increased from 7.5 to 7.9%. And the White House, literally, which I was shocked, after the inflation data came out at 7.9, issued their own press release saying that they expect inflation to be higher in the coming months than even now, right? And so I won't get into like who they're blaming it on all this. I kind of find that funny sometimes. But the bottom line is that means it's almost certain we're going to go into the 8s and higher. And as that happens, Powell will have no choice but to increase. And I say no choice because what could happen to the U.S. population and the people who are voting, if they can no longer afford things, if they allow this to compound year over year at 8% or 9%, it's devastating. So I think they're going to have the lesser of the two evils, in my opinion, is to end up in a recession, because the other one is just having a very big, and by the way, this is not a short-term problem you cause, right? Because prices don't typically adjust down after. They may stabilize and normalize. But when people can't afford to buy food and a hamburger at certain prices, the price of the burger isn't coming down in 2 or 3 years. It just maybe not going up as fast. So it's good. The amount of societal problems we can have if they don't deal with inflation properly, I think very much outweighs ending up in a recession. But that's just my own take on it.
Mm-hmm. Well, Jeremy, I tell you, man, unfortunately, we're getting near the end of our time, but looking back and just all the different points that we've covered so much ground in just such a short period of time. And we've condensed a lot of big nuggets here. And look, again, I just want to highlight my respect for you and the level of sophistication that you have as an investor, being so in tune to the macroeconomic landscape, the investing landscape as a whole, and just really understanding, like Brian said, who you are as an investor and what drives your investing strategies, and really positioning yourself to weather any potential downturn. So a lot of kudos to you, man. Again, just really appreciate you giving us those insights today. Brian, any thoughts for Jeremy before we go to our final four here?
No, I definitely echo the same sentiments. I appreciate everything Jeremy has said, and hopefully it added a lot of value to our listeners.
Yeah, we're going to have him come back for round 2 if he'll have us. What do you think, Jeremy?
That's it.
I'm always happy to come back. Yeah, for sure.
Awesome, man. Awesome. Well, listen, before we jump off, there are a few questions that we do like to ask all of our guests, and just to get a little bit more in tune to kind of what you got going on in your business. So tell us what you like to do for your continued education to further your investing.
Absolutely. So I don't think this is realistic for most people, but I read at least 2 to 3 hours a day of economic news, real estate news, et cetera, to try to keep on top of what's going on, to get this kind of high level vision of where we are and where things are heading. So that I do that every single day.
Couldn't tell by any point in that conversation. Looking back at your journey, Jeremy, what was that one pivotal moment or experience that you had that really changed the trajectory of your business?
Yeah. Well, I would say that I had a last straw moment in the corporate world that actually caused me to leave the corporate world, because I didn't have this plan actually to rotate my money from stocks and bonds to get out of the corporate world with the cash flow. I meant to actually have the cash flow and the paycheck together. I just wanted more predictability in my retirement account, like I mentioned before. So one of the worst things that could have happened to me, which was a kind of a last straw moment in the corporate world when I was working at my last job at Toyota headquarters, turned out to be one of the best things that happened to me and put me on this full-time cash flow path. So I know that's not exactly what you just asked, but it's the immediate thing coming to mind that really, so, and I've seen other people be in a similar situation where they weren't planning on leaving the corporate world. They did. It ended up being the best thing that ever happened to them. And it's a very difficult challenge at the time. But man, getting out of the corporate world, it just changed everything for me, allowed me to focus on this full time, and we could talk about that for a long time, but it's a huge, huge change.
Awesome, man. Awesome. What would be one piece of advice that you'd give to our listeners to help them grow their businesses?
I would say I'm a little biased because I tend to be hyper organized, but trying to be as organized as possible. I plan for my meetings the day before. I'm very, very organized on follow-ups, so they don't fall through the cracks, flagging emails, all this type of stuff. And there's a lot of tools you can use these days to really kind of keep yourself efficient that are either free or close to free. So I would say that staying on top of things and being as organized and efficient as possible, efficiency, if you could just eke out the most efficiency out of your time, that could be a huge win for someone who has a small business.
Awesome, man. Yeah, great advice. Great advice. All right, Jeremy, tell the listeners how they can learn more about you and get connected with you.
Sure. So, anyone's welcome to reach out to me, whether you're a brand new investor, if you want to network as an experienced investor, if you want to, if you have opportunities, I'm happy to look at them. If you're another investor group and you want to network, just feel free to reach out to me. Best way to reach me is my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com.
Awesome. Jeremy, thank you again so much for joining us on the show, man. Look forward to staying connected, buddy.
Absolutely. Thanks for having me on, guys. I hope this is helpful for your listeners for sure.
Absolutely.